Hello and welcome. In this explainer, we're going to get to grips with one of the most fundamental parts of accounting, measurement.
So, you ever wonder how accountants do it? How they'd slap a number on everything, from a machine that's been sitting in a factory for 10 years to a loan payment that's not even due yet? Well, that's the big question we're tackling today, and by the end of this, you'll have the answer. Let's dive in.
Here's our game plan. First, we'll cover the basic rules of measurement. Then we'll open up the accountant's toolkit and look at the four main valuation principles. We'll put them head to head to see how different they are, talk about what to do when things get a bit fuzzy and uncertain, and then we'll wrap it all up with a quick review and a little quiz to make sure it all sticks.
All right, first things first. Section 1. Let's get on the same page. When we talk about measuring in accounting, what does that actually mean?
Well, this quote from Professor R.J. Chambers really hits the nail on the head. Measurement is the assignment of numbers according to rules. The key phrase there is according to rules. This isn't just guesswork, right? It's a structured process. Without those rules, the numbers we come up with would be totally meaningless.
And Chambers breaks it down into 3 simple steps. Step 1, you've got to identify what you're measuring. Is it a building, a sale, a loan? Step 2, you pick your standard, your scale. How are you going to measure it? And finally, step 3, you evaluate that scale you've chosen. Is it the right tool for the job? So, what's our scale in accounting? It's pretty simple. It's money. Whether it's rupees in India, dollars in the US, or any other currency, money is our universal yardstick. This is a big deal. It's a core concept we call the money measurement concept. Okay, but here's where it gets interesting. Is money really the perfect ruler? Is it a stable, unchanging way to measure business activity? Let's dig into that, because it's not nearly as simple as it sounds. Think about it. A kilogram is a kilogram. Today, tomorrow, next year. A meter is always a meter. They're stable. But money? Not so much. 100 rupees today doesn't buy the same stuff it did last year, thanks to inflation. It's kind of like trying to measure something with a ruler that's constantly shrinking and stretching. It can be pretty tricky. And this table is a perfect example of what I'm talking about. At first glance, things look great. Sales revenue is up by 8%. Woohoo, growth. But wait a minute. Look at the units sold. They actually went down by 10%. All that happened was the price of each item went up. So the money numbers tell a story of growth, but the reality on the ground is decline. This shows you just how careful you have to be. Okay, so if money is this wobbly ruler, how do we use it consistently? Well, that brings us to section 2. We're going to look at the 4 main valuation principles. You can think of these as the essential tools in every accountant's measurement toolkit. First up, we have historical cost. This is the old school, the classic, the one you'll see most often. And there's a good reason for that. It's based on facts. It's objective. You can pull out a receipt and prove it. It's simply the price you paid to get an asset or the amount you got when you took on a liability. No guesswork involved. So let's apply this to our example with Mr. X. He bought a machine for 7 lakh rupees, but he also spent 1 lakh on installation. The historical cost isn't just the purchase price, it's the total cost to get it up and running. So that's 8 lakh rupees. And for his bank loan, super simple. It's the cash he got in his hand, 5 lakh rupees. All right, tool number 2 is current cost. This one is all about the here and now. It completely ignores what you paid in the past. The question it asks is, if I had to go out and buy this exact same asset today, what would it cost me? Or what would it take to pay off this liability right now? It's all about replacement. And wow, look at the difference this makes for Mr. X. To replace that same machine today would cost him 25 lakh rupees. That's a huge jump from the 8 lakh historical cost. And his loan? If he wanted to settle it today and there was a small penalty, it would cost him 5 lakh and 5,000 rupees. See? A completely different set of numbers. Our third tool, Realisable Value, is kind of the opposite of current cost. Instead of asking what it costs to buy something today, it asks what you could get for it if you sold it. It's an exit value. What's the selling price in an orderly sale? For liability, it's what you'd have to pay to settle it in the normal course of business. Back to Mr. X. If he decided to sell his machine today, he could get 20 lakh rupees for it. Now, notice that's different from the 25 lakh it would cost to replace it. Selling price and replacement cost are not the same thing. And for his loan, the normal settlement value is just the outstanding amount, 5 lakh rupees. Okay, get ready because our fourth principle, Present value is the most complex, but it's also incredibly powerful. It's all built on this one big idea, the time value of money. And all that means is that money you have right now is worth more than the same amount of money you'll get in the future. Why? Because you could invest the money you have today and earn interest on it.
So how do we calculate this? Well, we take all the cash we expect an asset to generate in the future, and we discount it back to what it's worth today. We use something called a discount rate for this, which is basically an interest rate. So that 1 lakh rupees Mr. X's machine is expected to make in 2022, at a 20% discount rate, it's only worth about 83,000 rupees today. The 1 lakh he'll get in 2023 is worth even less today, and so on. We're pulling all that future money back to the present.
And when you add up all those discounted values for all 10 years, the present value of the machine's future earnings comes out to just 4,019,246 rupees. We do the exact same thing for the loan, but with cash outflows, the payments he has to make. We discount them all back to today, and we get a present value of 4,070,094 rupees. All right, now for the big reveal. We've just gone through 4 completely different ways to measure the same things. Let's put them all side by side and see what that looks like. This is where it really gets clear. Just look at that table. For the exact same machine, we have 4 different values: 8 lakh, 25 lakh, 20 lakh, and just over 4 lakh. That is a massive range. This is the most important takeaway. There is no single true value of an asset. The number you get depends entirely on which measurement rule you decide to use. Okay, so far everything has been pretty clear-cut. But let's be real. Business isn't always so neat and tidy. What happens when we can't measure something precisely? What do we do when we're facing uncertainty? Well, that's when we have to start making estimates. Think about it. There are so many things on a financial statement that are impossible to know for sure. How much of your sales will turn into bad debts? Exactly how many years will this new asset last? What about warranties or legal issues down the road? For all of these, we can't measure them perfectly, so we have to rely on estimates, using management's best judgment based on past experience and current information. Here's a great example. You buy a machine and estimate it will be useful for 10 years. But after 3 years, some brand new, amazing technology comes out that makes your machine obsolete. Well, you have to revise your estimate. You can't just stick with the old 10-year number. You might change it to, say, a total of 6 years. You don't go back and change the past 3 years, but you adjust your depreciation for the future based on this new reality. Whew, okay, we have covered a ton of ground. Before we go any further, let's do a super quick review of the key takeaways, just to make sure we're all on the same page. Okay, here's the summary. Remember the 3 elements of measurement: identify, select a scale, and evaluate. Our scale in accounting is money, but we know it's not a stable one. We have our 4 main valuation tools: historical cost, what you paid; current cost, what it would cost to replace; realizable value, what you could sell it for; and present value, what future cash flows are worth today. And finally, when we can't be precise, we have to make our best estimate. All right, you've listened patiently. Now it's your turn to do a little thinking. Let's test your knowledge with a couple of quick questions. You ready for this? First question: true or false? The 4 generally accepted measurement pieces are historical cost, current cost, realizable value, and future value. Think carefully about that last term. And the answer is false. It's not future value. The 4th one is present value. We're always bringing future amounts back to their value in the present. Okay, next up. A machine was bought for 10 lakh rupees. Today, a similar one costs 20 lakh. You could sell the original one for 15 lakh. So what is its current cost?
The answer is 20 lakh rupees. Remember, current cost is all about the replacement cost. What would it cost to get a similar one currently?
All right, one more, using the exact same information. What is the machine's realizable value? You got it. It's 15 lakh rupees. The realizable value is what you could get by selling the asset. Fantastic. So, that leads us to a final, really big question to think about. Now that you know the rules, which of these principles do you think gives the truest picture of a company's health? And you know what? There's no easy answer. Historical cost is reliable and verifiable, but it might be totally out of date. The other values are more relevant to today, but they can be subjective. So do you prefer the hard fact from the past or a more relevant estimate of today? This is the fundamental trade-off that accountants deal with all the time. Thanks so much for joining this explainer.